And if we look back, say, at the True Potential portfolios, the Barnes portfolio since launch, which would have been the 1st of October 2015, that's up 45%. So a client would have got just under 6% per year, and that's after fund charges.
Yeah. How much do I need to retire on? So when I'm thinking about this, it's all all well and good of saying, well, you need to save for the long term. Well, actually, how much do I need to, if I want to retire at 65? How do I work out those amounts? And how do you do that, John, when you advise clients specifically on the...
Actually, volatility can bring opportunity. A good fund manager can buy low, sell high, but they can only do that if you have that volatility.
Good morning, good evening, good afternoon, whenever you're watching or listening to our podcast. Welcome to number 121 of Do More For Your Money podcast. I can't believe we've got to 121. It'll be 122 next week, Chris.
It will. Exciting times.
We've got an exciting session today. It's about market volatility versus your pension, and really why long-term investing is an important part of investing, especially when it comes to saving into your pension. Joined by a great panel today. First of all, Chris Leyland, Director of Investments, Rebecca Wright, Head of Client Servicing, and we've got a debutant, John Mason, Pension Transfer Specialist. Hello, Jamie. John, how are you?
Yeah, very well, thanks, Jamie.
So your first podcast, can you just give a bit of an introduction of what you do at True Potential?
Yeah, of course. So at the moment at True Potential, I'm one of the company's pension transfer specialists. So my job is to give advice to clients on their workplace, their final salary pensions that they've had with previous employers, and decide whether it's in their best interest to transfer into a personal pension. So I essentially look at the client's financial position and decide what the best thing to do with their pension is.
Excellent, thanks, John. And I think we were talking earlier, but just tell us a little bit about how you sort of got into that role at True Potential, because we talk about sort of progression within our business. I think it's important for people to understand how people get to those roles that help our clients.
Yeah, of course. So it was just over 5 years ago that I started here, and it was just in a support capacity, really, just helping advisors to use the technology. And then since then, True Potential's put me through my exams. I've got my advice qualifications, and obviously I'm giving advice to clients each day. So it's really started from having minimal knowledge to giving advice to some of our clients.
John's one of these people who just reads a book and then he just passes the exam. I remember doing EF7, which for our viewers is the pension transfer exam. It took me 3 attempts, and John did the same exam as I did for the 3rd attempt, and he passed it first time and got a better mark. So very, very clever job. Welcome, John. Really good to see you. I think let's get straight into the crux of the podcast today, but. Before we do that, we kind of want to just share a little bit of how you can view and listen to podcasts. So I personally listen to these podcasts via Apple, via the download buttons, and I think it's just important that people are aware that you can download the podcasts from Apple and Spotify. And if you're boring like me, Chris, and you're going for runs and you want to listen to the podcast, that's what I actually do. Tends to make go faster. The better it gets, but so if you do look at different ways of listening, it's good to sort of listen in the car. If you want to download that, so please subscribe to. You can do it via Apple, or you can do it via Spotify, and we'll share the links after the session. But let's talk a little bit about the volatility, Chris. I know I'll come across to you straight away, because it's been a busy 6 months. It's been an interesting 6 months, and I think it's, for me personally, you're probably frustrated with me coming up to you all the time asking what's going on, because you're managing my money as well. But just tell me, give us a little bit on the week, Chris, as a whole, and then we'll kind of just drill into a little bit of actually why looking at a long-term approach is the right way.
Yeah, I think if we look at sort of maybe starting with this week, and then we'll build it out over the last 6 months, and then I think within that, one of the things that's so important for me to get across in the podcast is the kind of short-term versus the long-term benefits of investment overall. But what's been happening in the week, as usual, there's a lot of things that have been happening in the week overall. Probably the 2 most interesting things that I found was, firstly, what's been happening in China. So for those that don't know, China has something called a zero COVID policy. Now, what that means is basically if someone or a small group of people catch COVID, then they immediately lock down that area. And what you've seen is really significant lockdowns in China overall. So you saw like Shanghai lockdown, Beijing lockdown, and different other kind of regional provinces as well. Now, what was quite interesting is you saw Shanghai start to come out of that lockdown, which was on Monday, which was really good, really, really positive. Unfortunately, in the last few hours, Shanghai's actually started to go back into lockdown. So maybe a little bit less positive. But I guess what has been happening in China is you're starting to see the authorities be a bit less difficult with the big tech companies. So you've seen things like more video game approvals come through. You've seen a lot of the kind of people that were targeted, so like Jack Ma from Alibaba. A lot of that stuff seems to have softened. So one of the key things that we're looking at as a team is what's happening in China and the potential for that to grow returns as we move through the year. So I think that's quite interesting. I think the second thing is just what's happening with the oil price. The reality is you've got the oil price at $121 per barrel today. We've got oil up 55% year to date. For anyone that uses a car, visits the petrol pump, will know that petrol's incredibly expensive right now. I guess, what have you seen? So you've seen supply shortages, so particularly exacerbated by what's happened in Ukraine. What you've seen is even though the prices are rising, you've seen continual demand come through. So obviously the oil price is a function of supply and demand. And within that, you've seen really strong demand come through for oil and actually even strengthening demand. So one of the things that we were looking at as a team was actually what happens when China comes back out of lockdown. Will you see further demand there? And will that actually increase the oil price overall? I know one thing we were actually talking about before was, how negative is that? And in some ways, it's negative for individuals in the sense that, we're consumers of oil, and obviously oil is more expensive. It's negative for things like, say, travel companies, where they either have to pass on the higher prices or take it on themselves. But actually, if we look at TPP, we've got investments in oil companies, and those oil companies have done fantastically well. If you look at the share prices of some of the big oil companies, things like Chevron, stuff like that, they've done really, really well overall. So I think for me, really interesting week. If we build that out over the year, I suppose the key things that people are discussing, that we've been discussing, is inflation, central bank policy, so rising interest rates, what's happening in Ukraine, and what's happening in China as well. So I think it has been a challenging start to the year. I would never sit here and say it's not, and I think we've seen that come through in the very short-term returns. But I think for me, if we still look at those long-term returns are incredibly strong.
And I think that's where we have to sort of drill into it from a pension perspective.
Yeah.
Because on average, if you're starting your pension contributions at, let's just say 20 to make my maths very easy.
Yeah.
Then you've got 45 years worth of savings in that period. But anything sort of up towards, for me, anything over 5 years, you should be investing in a market basis. Anything less than 5 years or need for money, then and potentially not, and you should have a conversation with your advisor. But you've got that long-term period, and you should look at over a long-term period. And I think what we do know is that 10 years ago the world looked very different as it does now. And it's you've got newer companies involved and etc. And I think this is why, when you're doing your sort of investment approach, just tell the viewers, Chris, just a little bit how do we look at it from a long-term perspective. So when the fund manager underneath are picking the sort of individual stocks, etc., and we are from True Potential's perspective, how do we view that to say, well, actually, what's the long-term view of this investment?
It's a really good question, Jamie. And basically, you have what you call strategic, which is long-term. Then you have tactical, which is taking kind of smaller positions, so taking advantage of kind of day-to-day opportunities that may come up for dislocation in prices overall. And the reality is strategic is the main driver. If you look at from a percentage perspective, strategic's probably like 85% of the driver of return. and then you've got tactical, which is like say 20, 15%, something like that. So for us, what we do is we take a longer term view on what's happening and what's happening from a macroeconomic perspective, what we believe will be the best asset classes to play that overall. So that would be reviewed, it depends on which manager you look at, but that would be reviewed probably normally annually. But then within that, there's then tactical positions that are taken around that overall. I think the key thing, Sonny, that I want to get across within the podcast is, the reality is that clients are invested for the long term. And, if we look back, say, at the True Potential portfolios, the Barnes portfolio since launch, which would have been the 1st of October 2015, that's up 45%. So a client would have got just under 6% per year, and that's after fund charges. Aggressive client would have got around about 8% per year after fund charges.
And that's including this wobbly year as well, isn't
Absolutely, yeah. And I think one of the real dangers is, people really focus on what's happening in the short term. And everyone does it. It's normal to do it. But the reality is markets go up and down in the short term. We're talking about volatility today, and actually volatility can bring opportunity. A good fund manager can buy low, sell high, but they can only do that if you have that volatility in there.
Potentially why you're looking at China at the minute as an opportunity.
Yeah. So, but I think for me, the long-term reasons to be invested are 100% intact. The reality is you need to take some sort of risk to hit your goals. If you're going to be invested in cash, what are you going to get? 1%, 1.5%. I'll be really, really generous there. And you've got inflation at 9%. You're guaranteeing that you're making a loss. You're guaranteeing that you're not going to hit your goal. Whereas investing, taking risk, investing in a high-quality multi-asset solution, like the True Potential portfolio proposition, is a way that you hit your goals overall.
And let's go across to that, because I think, Rebecca, can we just talk a little bit on the technology perspective? So if clients want to look over a long-term basis, how do they do that on their sites and their apps?
So clients can configure the charts within their sites to show exactly whatever date range they want. So when they first log in, it'll be set as a default time range, but you can see just in the top right corner of every chart on every single screen within the client site and within the apps, there's little sort of buttons there where you can change it 1 month, 3 months, 6 months. But actually at the very top of the page, you can also input just free range dates. So if you want to look at it from the very start of your investment, or you want to look at it over a 30-day period or anything like that, you can configure it exactly how you want to see it.
It's good to look at that, because I believe at the minute it'll work on the basis of the last time you logged in. I know you can see it over a period, but it's worth just expanding that out just to see what is...
especially if you log in regularly as well, because it's only showing you a very short range.
Yeah, and I think that's quite important. I think let's just kind of just take a step back. I'm very aware we've got a sort of a mix of age range in the client, mix in terms of all age, well, mix of age range in here, Chris, but also a mix of age range within our clients. And I think let's just talk about how does, I think a key question I get asked, and John, I'm going to bring this across to you, from an advice perspective. You'll get asked this quite often: is how much do I need to retire on? So when I'm thinking about this, it's all all well and good of saying, well, you need to save for the long term. Well, actually, how much do I need to, if I want to retire at 65? How do I work out those amounts? And how do you do that, John, when you advise clients specifically on the finance savvy pension transfers?
Yeah, so what I would say is I think everyone is different. Everyone spends their money differently. So, if you're looking at a client who's coming up to retirement, a lot of the time they might have a mortgage. That tends to be a big part of their expenditure, and when they're moving into retirement, that cost will often drop out, so you'll tend to see a little bit of a reduction in expenditure there. But when we're looking at a typical client, we'll generally see things, perhaps travelling to work, fuel might drop out, and for me, I don't think you would ever see a drop of, say, more than a third of what a client would currently spend in their working life. So you're going to have more free time, so you might be going out a lot more, you might be going on holiday a little bit more. But generally, I think 2/3 of what you're spending during your working life is a reasonable assumption, is what we tend to take.
Yeah, it's funny when I speak to clients, they'll do the same as yourself. You'll write down their current expenditure, and you go, right, this is what you're spending. And the other thing you kind of do is go, well, how much you earn in a month, and is there a difference between that, so you can see any discretionary expenditure that's missing. But if you actually just physically write down from your bank, this is what I'm currently spending, and then look at actually, well, what will I be spending in the future? So the chances are, as you say, you may not have a mortgage. You'll know when that ends, so that kind of comes out. But you may spend a little bit more on travel because you've got a bit more time on your hands. You may spend less on petrol or a bit more on petrol. It depends if you could have been from an environment where you're working from home now, or you could have been traveling to work. And I think that's quite important because that'll tell you, that'll give you some good understanding. So then, how do you work it on a basis, John? And so if I need £20,000 a month or £30,000 a month, God, that would be good, wouldn't it?
I was going to say, you've got quite a lavish lifestyle.
Yeah, definitely not. So I'll not make any further comment on it. But yeah, £30,000 a year. How would I go, right? Well, this is how much I need to save. I'll bring Rebecca in as well, but because the technology can help with this. But how would you say, well, this is how much you need from a pot
of course.
saving?
So I think life expectancy for most people these days is in the mid 80s. So if you're looking to spend around £30,000 a year, you've got to make that last for 20, 30 years once you've retired. What we'd do to start with is we'd take into account things like the state pension. That's obviously a good starting point for income in retirement. A married couple will have a little bit over £18,000 a year from their state pensions if they've got the full amount. So, if you need an extra 12 to retire comfortably, we would look at a safe withdrawal rate.
Yeah.
So the amount of money you've got in your pension, how much could you safely take each year without diminishing the fund? And for a £30,000 income, you'd often look maybe to take 4% a year.
Yeah.
Would be a reasonable amount. So if you times that up by 20 or 25, you'd have a reasonable idea of how much you need to last yourself throughout retirement.
And let's bring that into the technology now, Rebecca, because sometimes I've got a pot now. People might think, well, actually, if I've got a pot of 100,000 now or 50,000 now, and I retire in 20 years' time, I've got to put, it's not just a case of taking 300,000 off the 100,000 and putting that much in away a month. It could be, you obviously get the growth rates from Chris's performance over that period. So how, from a technology perspective, what would you do?
Yeah, so we're not expecting clients to do all the hard maths themselves on that. The technology is going to do it all for you. So 2 sections I think within the site really to call out. The first being your goal setting features. So you can go in and input how much you're earning now, how much you would like to have on an income basis in your retirement rather than total pot size. You can say I'd like this much money each year. And it'll work out for you how much you would then need to put away based on what we already know you've got saved up, based on inflation rates, based on growth rates, all included in there as well, and give you the figure of here's how much you should be putting away each month. It'll make suggestions for you, so if you're already putting some money away, it'll let you know if that's maybe a little bit more than you need to put away, or maybe it's the other side and it's not quite enough. But then also looking at how much you can actually afford to put away. We've got a new feature coming into the site very soon called Personal Finance, and this is going to allow you to pull in all of your income and expenditure from your bank account with a direct feed and actually then do the calculation for you of how much disposable income you've got, so you don't have to do that, sit down and work through the bank statement to look at what is and isn't needed.
Yeah, you and I are currently testing that as we speak, so it's watch this space. That should be a great little feature. It's funny, we were talking before the podcast, I was mentioning, for some reason every time I go on holiday I end up giving pension advice. I don't know if it's I'm boring or people just kind of just attract around us as soon as I tell them what I do for a living. I'm not sure, but I was talking to this individual about his pension. He says, I'm only putting this much away in a month, and I says, well, I think it doesn't sound quite right for your salary. So he showed us his pay slip, and I pointed out that his employer was paying into his pension, and he wasn't aware of that because all he's seen on his pay slip was pension contribution and didn't look at the bottom, which is your employer pension contribution. So this is quite an important thing actually, is just try to understand how much actually are you putting into your workplace pension, because if you are working, the likelihood is you probably are contributing to your pension, and your employer will be. But also actually there's a lot of workplaces do matching schemes where if you pay a certain amount of money in, they'll pay amount in, and these are the sort of things to look at when you're looking at that goal and objective. As Rebecca says, you get the technology, this is how much I need. Start to think actually, well, how much am I putting in, and can I afford that little bit more, which is what we're talking about with the budgeting. But there's other ways obviously for doing. We're talking about the budgeting, Rebecca. Let's kind of plug away. We kind of talk about impulse save quite a bit, but I think it's worth just mentioning again, if you do have that saving, how do people sort of add that to their pension and the...
Yeah, so you've got your direct debits set up. We can take direct debits, but another kind of quicker or perhaps more of an ad hoc way, if you've got a little bit of spare cash at the end of the month, is to use Impulse Save, which is just like making any other online transaction. Save your card details in there for next time, go straight into your app, straight into your website, and click on a button, click on the card you want to use, and tell us how much it is that you want to pay in. You can use that with as little as £1 right up to £99,000, so it's really flexible for clients with what they're paying in. I think that going back to the goal setting features, what it'll allow you to do on there when you go on to Impulse Save is it'll ask you, do you want to close the gap to your goal? So if you're just a little bit behind your goal and maybe you've fallen behind over the last few weeks, you can actually just select to put in that exact amount, which will get you back on track. And again, the system's doing all of that calculation for you rather than you having to go and work it out.
Yeah, I think it's interesting. I don't know. I think Chris, as an expert, how do you handle how do you handle your pension savings now? Because you're a little bit away from retirement. I know I'm joking. You're a little bit away from it. How, we're talking about a long-term area here. So I don't know. When are you thinking of retiring? And, don't tell anyone to say me, but
yeah. So I'm 44.
Yeah.
Ideally, I would like to retire when I'm 60. Okay, so that would be my goal. Within that, I guess, what does that mean? It means that I have to save up very hard. I think, one of the things that maybe we haven't talked about is actually most people are not saving anywhere near the amount that they need to save. It's we obviously have the kind of pensions crisis, which has been discussed. But I think for me, there's a couple of things that you can do. Obviously once the money is in your pension, you can't take it back out. Mm-hmm. So in that sense, if you this is the way I would do it. I set up a direct debit, which is part of how the salary sacrifice that we have. And I just have that immediately come out of my salary. Then it's gone.
Yeah.
I can't touch it. It's in my pension. Don't think about it. I think the second thing is to, in some ways, take control of your finances. So what I mean by that is, in some ways it's quite easy to bury your head in the sand and just think, everything's going to be fine. But the reality is if you don't save, it's not going to be fine. And you'll be working till you are much older than 60, much older than 70 potentially. So I think you've got to say to yourself, look, I'm going to have to at some point make some kind of sacrifices here. If that means not going to the pub or eating out at the weekend, one weekend, and saving whatever it is, 100 quid or something like that by not doing that, putting that money in, and just accepting the fact that actually, by doing that, firstly, you get the compounded growth on that. Yeah. And then secondly, it means that you can retire earlier.
And also the tax relief if you put it into a pension.
I mean, that's if you think we don't get that much stuff from the government.
Yeah.
And the reality is, you get pensions. You get the tax back on it. It's tax free. You've got to make sure that you use these things that are given to you. The reality is that we don't get given that much, and it's important to use them. Now, the earlier that people save, and obviously there's different people at different ages who'll be watching this, but the earlier that you save, the better it is, because you get those compounded returns. If you're putting money in when you're 20, you retire at 60. Even when you retire, your pension's still making money after that. But the reality is you're compounding up all those returns. So for me, so that's a really long answer to your question. But for me, in summary, is what do I need to do is basically you need to save. And you need to save early if you can.
Yeah, and I think it's never too late.
No, I agree on that as well. Yeah.
Sometimes but it's actually never too late because it can help. I think you make a really good point there, Chris, because I think we're kind of talking about what we would class as accumulation customers, where they're saving for their retirement. But when we think about long-term investing, if people are retiring, obviously their money's still invested.
Absolutely.
So what I would say I'll talk about the investment point of view in a second. But what I would say from an advice perspective is we do have to, if you're looking to retire and you're going into drawdown and you're taking income from your pension or mix of income and tax-free cash, you have to look at your risk and see is that the appropriate risk for you. And I think, John, this will be something you do on a regular basis with clients in terms of talk about the risk. What would you recommend to our viewers on that basis?
Yeah, so the amount of risk that you take, it's again a personal decision. With our portfolios, the portfolios that Chris runs, there's 5 different risk categories to choose from, and each of them will give you a better or worse potential for growth depending on how much risk you're willing to take. For us, it's really how much you're prepared to lose in a potential downturn. how much you're prepared to make on the upside. So when it comes to retirement, how much you need will essentially factor into how much risk you will take.
Yeah, it does. It's what the capacity for loss is what we talk about, isn't it? Quite a lot,
exactly.
Which is if your fund did drop, how would that affect your standard of living? It's part of the advice. And what I would say to any client that's thinking about retiring or currently retiring and going and looking at their funds, give us a call or speak to your advisor, and they'll talk you through and look at the sort of longevity of the fund as well. Because it could be as well. A lot of clients I've spoke to, we've actually reduced their income slightly while the markets are volatile, so we're taking less out. And in fairness, not everyone can afford that, but these specific clients were able to afford that, and that can help obviously in terms of for future growth, and we can amend that in the future. So it's one of these things. The other thing I would say is always when you're looking at taking your drawdown at retirement or taking your income out at retirement, just make sure that at the end of the year, check how much cash you've got left in your bank. See if you're taking out too much or too little, and then have a discussion with your advisor. It's better in your pension. There's better tax benefits to that. Because from a volatility point of view, though, how would what would you say to clients that are got 15 years left in their pension, they're retiring, they're taking income from it? What to do within the portfolios to sort of support that?
I mean, the reality is I think the key number there is your 15 years.
Exactly.
So, and exactly. I think within that, 15 years is a really long time frame. I gave the performance figures before. That was 6 years worth of performance. Yeah. Imagine what that would be like over 15 years.
You had hair before the start of the performance, Chris, didn't you?
I didn't.
No.
I wish I did.
Yeah.
But no, I think for me, the reality is 15 years is a long time. And when we look at equity markets and you look at how equity markets move, the reality is over 15 years you can make a really significant amount of money. Now, what I would say is it's not going to be a very smooth, perfect line. There's going to be times when you're making a lot of money. Probably a good example of that would be, say, 2021. There'll be times where it's a bit more challenging. Probably a good example of that is so far this year. Mm-hmm. But the reality is when you compound all of that up over the long term, you get really good, strong returns. Mm. And I think that's important. People, what I find is when the short term is quite challenged, people forget about the long-term benefits of being invested. The very best thing that you can do as an investor is to sit tight, to stay invested, to accept the fact that sometimes when you look on your app, it's going to say it's fantastic and you're doing really well. Other times it may say actually that it's down. Mm-hmm. But the reality is that the longer that you stay invested, you'll see your money grow and you'll hit that goal, whatever that goal is overall. And for me, that's the most important thing. You need to stay invested. Mm. The worst thing that you can do is to think like, I'm nervous about what's happening in Ukraine, or I'm nervous about inflation. I'm going to take my money out. Because the one thing that you're guaranteeing that you're taking it out at the wrong time.
Well, I think two things as well. You guarantee you're taking it out where it's lower, but also if you take that out and put that in cash, you're automatically losing 9% a year on that. Well, whatever. Let's take off your 1.5%.
Yeah, that's been generous as well. 1.5%.
You've got to think. So I think that's a good message to sort of finish on here. Is that it's important that you look at your objective. Why do you need this money? Yeah. It will be for the long term if we've recommended to you. If you want a discussion about short term, speak to your advisor, but sticking for this for the long term. Great. Thanks everyone. I think we'll do the usual what you're doing, because it's a Thursday today, isn't it? So it's not Friday. What you're doing at the weekend. We'll start off with you, Chris.
So I had what was definitely not a pleasure of moving house last week. Oh. So my wife-to-be has lots of things planned in the house for me to do this weekend. So my usual things would be like, I'm going to go out for food, or I'm going to go to the pub or something like that. I'm not. So I'm actually not having the most exciting weekend. And one of the worst things is we ordered a bed, and unfortunately this bed hasn't turned up yet.
Oh no.
So every day I get really angry text messages from her saying it's my fault that the bed hasn't turned up, even though it was my wife-to-be who chose the bed.
You are aware she'll probably listen to this, and I'll
will be, but maybe she needs to hear it. So we're currently sleeping on air beds. So yeah, this weekend we'll see how it goes.
I did wonder why I'd seen you in Newcastle all week.
I'm actually Newcastle all week next week as well.
I wonder isn't that a coincidence?
It's obviously because I wanted to be in the office.
Excellent. Well, good luck with that. There's a good chance you'll be DIYing it this weekend, I would imagine.
Yeah.
And it's interesting when you're moving a new house for the first time, you spot everything that you didn't see when you moved in. So
it was really bad because we kind of got to the house and it was the first time we'd seen it without furniture, and it didn't look the same.
You need to get your airbeds in there, Chris. It'll be fine. Rebecca, I know you should be having a quiet weekend with your future husband being away.
I am going to be stressing about my future husband's eyebrows for an entire weekend. I'm very, very concerned that he's going to come back with no eyebrows 3 weeks before.
Yes, he's on his stag do, isn't he? So
yeah, and then next week we might be going to get eyebrows tattooed on his face. Who knows?
Well, good luck with that
we'll
one.
come back intact.
Good luck with that one. And Johnny, you got any plans?
Nothing too exciting. One of my colleagues from the office, his brother's doing a jazz gig, so we're going to watch him perform, and then probably just preparing for a hike that I'm doing next week. We're hiking around Ullswater in the Lake District for charity. So.
There's a few of you doing that, isn't there?
Mm-hmm. Yeah.
What's the charity? Is from TP doing that?
Yeah, it's Macmillan Cancer. There's a few of us from the office doing it.
Fantastic.
So it's 26 miles around Ullswater.
Oh well, that'll be good fun. Well, good luck with that.
Thank you.
I'm at a wedding tomorrow, so that I thought was a Saturday. Rebecca's laughing at us because I had everything arranged for something else tomorrow, and then realised I was at a wedding last week. So I got two telling offs here. I got a telling off from Rebecca in True Potential. I'm my wife at home. So no, but I'm at a wedding tomorrow, and then I'll probably be recovering from that wedding on the Saturday. So I might have a little look at my pensions and see what I can put in it after that, Chris. I'll have 3 less pints and see what I can do. But no, great. Thank you, everyone. Just the usual sort of like and subscribe if you. Like the content you viewed today, but thank you very much. Thanks, everyone.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.